Well, let's return to the big story at the moment, which is an ET Now exclusive of the government giving feelers to the RBI to go ahead and hike the MSS limit. Suresh Chaudhary, the head of fixed income at IDFC MF, joining us here on Markets at Lunch. Good afternoon, Suresh. So that's the big story breaking on ET Now, and that we could see perhaps all of this being formalized in the next 24 to 48 hours. I'm guessing the idea, of course, being to absorb the excess liquidity that is now there in the system. Do you have any thoughts of that if we are going to see the MSS limit being hiked? To what kind of a limit it should be hiked to?
So, you have to treat this as a very operational exercise in the sense that the RBI had a finite capacity to absorb given the constraint of the amount of G-Secs they had on their balance sheet. So, they had the absorptive capacity roughly of around 7.5 lakh crores. Now, the ad hoc CRR was basically done as a safeguard measure so that they should never hit that 7.5 lakh crore limit, because had the total liquidity in the system surpassed that, what would have happened is your overnight call rates would have crashed. So, in order for the RBI to have sufficient absorptive capacity, they had to, in an ad hoc fashion, hike CRR with a very plain guidance that they would unwind the CRR hike as soon as possible. So, given that, the RBI should retain flexibility to issue as much of MSS bonds on behalf of the government as is required to maintain sufficient absorptive capacity so that call rates don't drop significantly below the repo rate. So, I would imagine this is just an operational tool in order to better the liquidity management exercise and to unwind the ad hoc CRR as soon as possible, because that obviously is a cost to banks' P&L as well.
So, I mean, what do you think? This is, of course, subject to a nod, really. This is just what our government sources are indicating right now. What do you think could be the limit which could be set aside from the bank side?
So, one way to think about it is that the ad hoc CRR took out 3,25,000 crores from the system. Now, if that needs to be unwound and MSS needs to be issued against it, the quantum needs to be similar. So it may not be to the exact extent of the 3,25,000, but it could be somewhere, in excess of a couple of lakh crores. Because again, if you look at from the total standpoint, as of yesterday, some 8 lakh odd crores of deposits had been tendered, against which around 2 lakh 10, 2 lakh 20 had been withdrawn. Now, the government of India, I think, expects that around 11 odd lakh crores will eventually get tendered. So, the RBI potentially needs a bigger absorptive capacity than just the 7.5 lakh crores of government bonds that reside on their balance sheet. So, I would think eventually the size of the MSS could actually total somewhere close to the amount of the ad hoc CRR, which is 3,25,000 crores. Having said that, I would think these MSS will be of very short tenure, because at this juncture, the banking system doesn't know what proportion of these deposits get converted into sticky time deposits and what proportion flows out once the new currencies are fully and abundantly available in the system. So, my guess would be that these MSS bonds would be for very short tenure, ranging up to 3 months or so.
Okay, so you're expecting them to be of a short tenure. So, Suresh, can you give us an idea of what kind of a reaction we're likely to see in the money markets? Would you expect a knee-jerk reaction? And what would it also mean for the Monetary Policy Committee meeting on the 6th and 7th?
So, I would imagine this is very similar to the RBI doing term reverse repo. If RBI was able to absorb more amount of money from the system via the term reverse repo channel, probably the MSS bonds would not have been required in the first place at all. So I wouldn't be too perturbed with these bonds, because one way to look at it is, suppose the RBI could have done 7-8 lakh crores of term reverse repos, the market would have been happy with it, because that would be absorptive, that would be excess liquidity, which you would have to tender to the RBI. The same thing now would happen via MSS bonds, with the additional feature that these bonds are tradable. So if you think that you require the money, you can sell it off in the market. So I wouldn't think the money markets will react very badly to this. And I don't think this has too much of an implication for the rate setting that would happen on 7th of December via the MPC.
Right. Just very quickly, Suyesh, before we thank you, what are the other tools besides MSS bonds that RBI has in order to absorb this gush of liquidity?
So clearly, if RBI perceives this as permanent liquidity that they need to absorb, OMO sales is one route. Again, I would think the probability of that is lesser, simply also because there is a kind of a growth impact of the exercise that the RBI needs to be cognizant of. And in the face of that, it's unlikely that they will actually shrink their balance sheet. Another way could be through forex operations, but those are also incidental in the sense that, if the rupee weakens excessively, the RBI would want to protect that, and that is naturally destructive to INR liquidity. A third would be MSS, that what they have done, or which potentially they will do. Fourth is a permanent CRR hike, but again, that is a tool that RBI would probably not want to use, because a permanent CRR hike also probably gives a mixed signal on the stance of monetary policy. So if RBI is in dovish and rate easing mode, it's unlikely that they would use a CRR as a permanent tool. So I would imagine a combination of reverse repo and the new MSS facility, if it comes about the way it's getting reported, would be the most ideal tools.
Okay, Suyash, good chatting with you, and thanks for putting it all into perspective for us. That, of course, is